Hello and welcome to the Aon Insight Series Melbourne. This is a session on intellectual property. My name is Brian Hinman. I'm the Chief Commercial Officer of the IP Solutions practice within Aon. And I'm joined by my colleague, Nick Chmielewski, who's the Chief Broking Officer of our practice. The topic today is on IP solutions for distressed markets. And really this is a very timely discussion given the current crisis that we're in, created by COVID-19 and the global economic crisis. And we're going to show you today how intellectual property can be a differentiator in creating opportunities to increase value as well as address and mitigate some of the risks that are created from COVID-19 and the global economic crisis. The first thing I want to talk about is really the IP asset class itself and how there's been a historical rotation from the value of companies from the shift from tangible to intangible. If we look back in history in 1975, for instance, here in the US, the value of the S&P 500 was really focused on tangible nature of companies. So the value was placed on property, plant, and equipment, primarily about 85%, and only 15% on the value of what we call intangibles. Intangibles, when I say that, we're really mainly talking about IP assets. So it's trademarks, trade secrets, copyrights, know-how, those kinds of things. And the companies, by the way, that made up those S&P 500, the top five were some of the leading capital-intensive companies of the world, like IBM and ExxonMobil and Procter & Gamble. If we fast forward to 2018, we've gone through 5 recessions between 75 and 2018. And during those recessions, IP has actually increased in value. And today, you're looking at about an 85% value rotation to intangible. So now that same S&P 500 is focused on intangible nature of the value versus tangible. And the companies that are making that up are companies like Apple and Alphabet and Microsoft, Amazon and Facebook, companies that that are really embracing the value of this intellectual property stack is what we call it. So that's this historic resiliency of the IP asset class and how well it's performed in and after recessions.
And one of the interesting things about intangible asset value is that when you think about innovation, we're in a global innovation economy. The way to turn innovation into an asset is by creating some sort of protection around that. Innovation plus protection creates an asset. And that is the idea of intellectual property and the things that intellectual property allows you to do as an organization as you shift your business model from tangible to intangible. Companies like Salesforce, Netflix, Apple, Amazon, those are 25-year-old companies, and the market capitalization has already far exceeded the likes of an ExxonMobil, for example.
That's a great point. So innovation in and of itself has to be captured and protected. Otherwise, you're at risk for other companies coming up with similar ideas and protecting them. And if they can do that before you do, then that same idea that you had might be very vulnerable to having someone else exploit and get value from that. So if we look at hindsight, is really 2020, lessons learned from previous market disruptions. If we look over time, and you see on the chart that during recessions, patent litigation and patent spend have been affected in a very large way. In patent spend, for instance, that's how much companies really spending on building a portfolio of IP. So in the case of patents, really filing patents and maintaining them throughout worldwide is very expensive. And so as you can imagine, in a disrupted economy, they're going to spend less. But what we're seeing is that there's a decrease marginally, and then they start accelerating in the recovery, really starting, you can see in this graph, really approximately at the market bottom, and we're starting to see that now.
The other interesting thing that you see with these sorts of trends is if you look at patent litigation, what tends to happen in recessionary periods is patent litigation tends to dip. You have a situation where courts are closed, companies are rethinking strategy, rethinking how they manage their business. So the first 6 months, there tends to be a rather significant dip in patent litigation. But the following 18 months after that 6-month dip, there tends to be a massive spike. That's largely attributable to patent trolls to companies who are going out there and buying up patents that are for sale as companies look to shed assets or as bankruptcies tend to spike. And so companies or non-practicing entities are going out there, picking up assets and looking to monetize those assets through licensing campaigns, through litigation campaigns, things of that nature. And so companies tend to often suffer quite a bit of experience with litigation around intellectual property following the initial onset of a recessionary period. We saw that in this most recent recession. If you look at the Q2 patent litigation numbers, we're up about 27%. We expect those numbers to continue to rise. Aon itself has already seen an increase in claims activity around its IP insureds that have intellectual property liability policies. And so we expect to continue to see a rise, at least for the next 6 to 12 months, in IP litigation.
Yeah, and I think it's and another reason for that is because companies are really strapped for cash. They're looking for any and all alternatives. CFOs are looking to saying, okay, uncover every rock where there might be potential money. And so they're looking at their portfolio as a weapon, and they can go out and they can assert their patents because guess what? They can go to the courts and they can extract tens and hundreds of millions of dollars potentially by doing a third-party litigation suit. So it becomes a very antagonistic environment with litigation. So Aon has actually shown itself to be an essential partner during this crisis and recovery in a lot of different ways. I think COVID-19 has created a lot of this global distressed economy that we've got, and businesses are trying to do whatever they can. I just mentioned CFOs are concerned about preserving cash. They're also looking at capital for liquidity. So they're looking at trying to figure out how to grow value, but at the same time curbing costs and really protecting that balance sheet. So you can look at IP as a way to do that. Also as a way for collateral for capital. You can use it in de-risking with insurance, and it looking at really as a way to opportunistically look at intellectual property as a way to increase your enterprise value by being able to strengthen what you have, by being able to grow your portfolio in a way that contributes directly to the revenue growth of your company. And there are very, very innovative ways that you can do that.
So Brian, question for you. When you were in your position at IBM as the Chief Intellectual Property Officer and reporting directly to the C-suite, how did you guys handle the IP assets in the last recessionary period?
Well, it was difficult because the company was going through, as much large companies do, with cost containment. You had a very, very large patent portfolio as well as trademarks and trade secrets. So we had to do a lot of what we call pruning. We had to go through the portfolio with a fine-tooth comb, eliminate patents that are of lower quality, or perhaps ones that were non-strategic, or ones that were really redundant. In other words, you have 10 patents that cover one innovation. You only need 3 because the other 7 are really not copycats, but they're really covering other redundant features on a technology set. So I think going through that and having companies analyzing their portfolio with that kind of an analysis really helps to shave a considerable amount of cost, and really doing analytics. And over on the right, you see we have an IP technology platform that really enables us to do that, looking at and separating patents based on quality and based on value and any form of intellectual property. That's a key way to do that. This next chart talks about really the unexpected market disruption and how COVID-19 is really reshaping the priorities. What we're hearing from the C-suite folks, CFOs particularly, are looking at, as I mentioned, this cost containment, cost management, and looking and really balancing this how do I shave costs, but also not really taking away something that's going to take away quality or value. So they want to improve near-term liquidity to weather some of these economic crises, and they're worried about hits to these cash flow and these earnings. Chief strategy officers are really looking at strategically how do they capture the right innovations to get the right market share. So they're working closely with the intellectual property heads, and the strategy officers are saying, what should I really focus on in the long, so that way it'll affect my short-term and long-term focus of my company.
Yeah, and most risk managers today are still trying to learn what IP actually is, but they certainly have a heck of a lot of concerns when you think about things like supply chain risk, vendor-induced risk, vicarious liability, and disruption to the business. They also care a lot about things that could be high-stakes litigation. IP infringement can be massive costs. It's quite a frequent sort of event for a lot of organizations. And you could have situations where you're suffering millions and millions of dollars in lots of legal fees for 3 to 7 year litigations. In addition to risk managers, heads of business development are trying to figure out ways to drive more revenue, produce more for the company. And so, they're thinking about different acquisition strategies, trying to be opportunistic, looking at ways to find innovative companies at a discount. And they're also looking at ways in which they can help their business units sell more. There are certain strategies that help them as they think about risk versus reward and what those trade-offs are. Brian, I'll turn it back to you. Why don't you talk about what IP officers?
Yeah, IP officers are really looking at, as I mentioned, curbing the costs of their portfolio without affecting the quality. So that's one key piece. But also they're looking at monetization. They're listening, working. I worked very closely with the CFO, for instance, at Phillips, and trying to make sure, at the quarter close that the company can end on a high note. So you're looking for opportunities to monetize the portfolio, either through perhaps shedding the portfolio and selling assets. You can actually go out. There is a market for going out and buying and selling patents. Or you can go out and license. You can go out and license technology. It doesn't have to be antagonistic third-party assertions. You can go out and actually take your technology and enable someone that needs that technology. And you can actually do that in a very non-threatening, very nice way where you're actually getting some return, but at the same time enabling an ecosystem to perform. And also looking at buying assets that really would add to the equation as well. So the team that we have at Aon really is a cross-functional team that brings a lot of different disciplines in leadership across the board. So we've got former chief patent counsel of Microsoft. We've got myself that was a chief IP officer at Phillips, former general counsel of Geely, and across the board. We've got technology development. We've got a team, a very strong team. I imagine half of the 140 or so IP professionals that we've got are focused on technology development, building out this middle piece, which is really this what we call IP genome platform, which is an AI-based, very machine learning, natural language processing engine that really helps articulate to develop tool sets around articulating quality and value of any form of intellectual property. So being able to quickly and very in a very thoughtful way analyze these portfolios and articulate what that value means to companies. Very, very important. And then we have the folks, very smart folks like Nick, that bring the IP broking, and we launched an MGA earlier this year, which is very good for us because it allows us to really address some of the challenges in the insurance markets around the world of intellectual property. We also have legal and advisory folks and M&A and capital markets and advisory folks for some of the lending products and being able to articulate some of this value and how we can morph it into value for companies.
So as Brian alluded to on the previous slide, the insurance industry hasn't been very innovative, hasn't been very effective in dealing with intellectual property related risk. One of the first opportunities that we saw when we formed this group was the opportunity to bring back catastrophic IP risk coverage. And that's effectively what we did. Through our MGA, we have the capabilities of writing coverage up to $120 million of limits to cover catastrophic risk for organizations when they deal with issues around IP infringement and the defense of those issues. You think about patent litigation or trade secret theft and misappropriation, or you think about matters like copyright infringement or trademark infringement. Additionally, a very big coverage component is contractual indemnity coverage. So a lot of times in distressed economies, Brian alluded to the fact that folks license out their IP. A lot of time they'll have to indemnify third parties, make representations around their intellectual property rights, defend them in the case that that third party is sued for intellectual property infringement caused by their product or technology. And the policy is able to transfer that risk. The insurers are willing to take on that risk. It's a big value add for a lot of organizations when they think about contracting and contractual risk exposure that they might have. What underpins that all is the technology, the ability to actually map patents to products, patents to markets, so you can start to understand what risk exists in your particular environment around your particular technology area, and then add quantification components to that so you can start to understand what is the total cost of risk in a given area for my organization. And the 60,000 plus litigation data statistics just weren't available 20 years ago. That's what we brought back to the market. And that's why we're able to effectively get a large limit solution in place. Today, we have the ability to place coverage for $250, even $300 million for particular organizations. But in addition to intellectual property liability insurance, we're also innovating. The insurance marketplace wants to continue to build coverage to protect intangible assets and tackle a big, big market for a lot of organizations. The other thing that we've been working with different organizations on is a trade secret theft insurance product. So being able to cover your crown jewels, cover the value of your crown jewels. Trade secret theft represents about $1 trillion a year problem. It happens quite a bit, whether it be through cyber events, unauthorized access, whether it be through rogue employees, or business partners. So organizations are starting to think about, how do I lock down my key secrets, my key competitive advantage, and then how can I ensure the value of those key assets that differentiate ourselves from our competitors? And those are some policies that we've been able to come out with today.
This is an interesting chart because this really shows the power of analytics and how a company can look at it from a risk perspective and an opportunity perspective, how to analyze portfolios. So what you see in the graph to the left are individual colored dots, which are colored by, separated by technology segment as well as by company ownership. So you see on the bottom left, you see the relative percentage ownership of companies that have percentage ownership of patents in given technology areas. Why is that relevant? So if a company really is looking at a portfolio that they're trying to see, okay, I want to get into a certain technology area and I want to explore who else is innovating in this space, it helps to point out, okay, so I know Cisco's inventing this space, and I want to see how much they're spending, or really what specific technology areas are they trying to hit on. So then you read each one of those individual patents and you try and understand where they're focused. So that way it'll point to areas that you can try perhaps avoid, because Cisco has some blocking patents that might block your technology entrance into a given technology segment, or it might create some of this white space. You see this dotted line that separates something non-core to revenue, but it might be an opportunity for you to exploit a technology where nobody's patenting. So it creates an opportunity as well as a way to mitigate risk, because you're trying to look at really trying to understand the landscape around where companies are patenting and how important it is to them. The other opportunity is with respect to identifying opportunities to prune the portfolio, because you've got on the upper right, it actually shows a graph where you're segmenting quality versus cost. So you're showing your portfolio, and we're able to articulate through a graphically format, being able to look at what is the high quality patents that you have, and then you can measure that versus how much is your total spend. And therefore, if you're looking to curb costs, you can identify some of the assets you might not need. Sorry, Nick, I didn't mean to step over you.
No problem. I was just curious, as a former buyer of analytics in your former positions as Chief Intellectual Property Officer, how do these analytics compare to what was available on the market? And maybe you can give the audience just a sense of how you can use the analytics as a risk manager to identify risk within the organization.
Right. So as I mentioned, I think from a risk perspective, they can look at the patents and the technologies that they represent, and being able to do this landscaping and understanding who's patenting what, where are they spending their research dollars, and how can I avoid traps that might be presented to me as a result of doing this kind of an analysis. I think with respect to the analytics that existed, say, even 10 years ago, we've come a long ways, because even 10 years ago, even companies now are looking at analytics surrounding citation analysis, where they're looking at, when I say that, you're looking at if you have an issued patent, you look on the face of the patent and you can see where companies have referenced your specific patent in trying to obtain their own. So the more, a lot of companies think if you reference, the more a patent is referenced, then the higher the quality of the patent itself. And that's challenged somewhat with the analytics that we do, because we're actually looking at that claim language, looking at that patent claim and doing the analytics and comparing that claim language versus any and other patents that might exist worldwide, and being able to articulate and separate, okay, what does this mean from a quality perspective? What does this mean from a risk perspective? What does this mean from a value perspective? That's truly the way to obtain that quality perspective.
In real time too, right?
Absolutely.
One of the biggest issues that IP insurance had historically was it'd take months, very, very long time to try and procure coverage. And it was really because you had to do a manual process of going to the Patent and Trademark Office, start pulling patents, understanding what's going on around there. And it was always sort of a finger in the air approach. These analytics give us the capabilities to write insurance coverage, in a matter of a week's time, as opposed to months and months and months to get indications on what pricing might be for policies. So with all the data and all the analytics that we've been able to achieve, one of the things that most clients ask us is, what's my risk? How much risk do I have? I want to tell the audit committee, the board of directors, I want to give them a sense of what our exposure is, how much is our exposure, what are we at risk on, and that's what the risk assessment process allows you to do. It allows you to take in more than 60,000 data points, apply it to your industry, your client, your size, and it allows you to get a view on what infringement risk you might have, on what trade secret risks you might have within your organization, on what contractual risks you might have, and also what sort of vendor risks might be happening within the organization. You're able to see sort of the financial modeling and how insurance overlay could help lower and mitigate that total cost of risk. But at the end of the day, you get a report that also gives you suggestions on how to mitigate that risk outside of just an insurance buy, and helps clients think about how they can look more attractive to insurance companies or just to the market, and reducing the overall risk for the organization. So Brian, I wanted to ask you as well, when you were at Philips, for example, how did you guys think about risk assessments, and how would you use something like this?
So we would do it by product unit, and also within the product unit, what are the different product segments? So we would have a strategic plan on record that we would regularly update every year. And every year we would look and analyze, okay, within this we would have, every product unit would have its own strategic plan on record. And you say, okay, these are the products we have. This is the revenue associated with it. Here's the portfolio that underlies that. So you look at the stack of trade secrets, trademarks, patents, and you look at how well they're protecting that. What are the gaps that might exist because you don't have adequate coverage to protect this product or this revenue stream? And how do you address that gap? How do you address the risk? There has to be a mitigation plan. So we would have a way that we either have to do a make or buy decision. We either go out and buy patents to fill the gap, or we do more R&D to fill that gap. But a company has to really analyze each individual risk, because it's rather than take it holistically, you have to peel apart the onion and look at each business and each revenue stream independently.
If it was available, would you have bought insurance to fill that gap?
I think that's probably what we would have done for some of the higher risk areas. So I would say that we had a lot of litigation, and I think at the time it would have helped to have mitigated those risks a lot better, because we did, some of the gaps you don't think they exist, and third-party threats can come from anywhere, even if there's a gap doesn't exist, because you say patent trolls are out there just trolling and trying to create havoc. And so insurance is a good alternative to address that. So yes, I think there were opportunities to do that.
So I mentioned a few times on the previous slide where we look at vendor-induced risk. And one of the things that Aon has come out with to help address some of those concerns is a vendor risk management technology solution. So really what this is is it allows an organization to upload certificates of insurance to make sure that their vendors are in compliance with minimum insurance requirements. This system allows them real time to validate the compliance levels, make sure that everybody is in compliance with the contracts. And in the event that they're not, it allows functionality to click for a quote so that a vendor could very easily obtain coverage in real time and get coverage for things like errors and omissions, for professional liability, for cyber liability, or for IP-related issues. The platform is also implementing some of the data and analytics that you're seeing in the previous slides here. So you can get a real-time view of particular product areas or technology areas and what the vendor risk is within that area. So real-time, the organization can start to understand, as they diligence new suppliers to come in and potentially supply a product, they can understand the risk associated with that and potentially mitigate it with higher levels of insurance and use the data to help inform that decision. We talked about liquidity, and one of the interesting things that Aon just came out with was an IP collateral product. We were actually just in the news a couple weeks ago, earlier this month, with an announcement that we just closed our first transaction, $100 million deal, where we insured the value of IP used as collateral for debt financing. Now, this was a company that may not have had the balance sheet to support a traditional cash flow loan, and they needed to use some sort of asset-based lending type of solution. They had a tremendous amount of IP and intellectual property value, but unfortunately that is not accounted for today by most banks or most lenders, most financiers, because it's not a balance sheet asset. And so one of the things we were able to do was wrap that value with the insurance markets and give certainty to the lender that the collateral value would be there in the event of a default. We were able to close that $100+ million transaction at a relatively fair cost of capital for an emerging growth company. Brian, what other examples could you use with?
Yes, the second example that we've got is a large company in the U.S. that had a very well-funded captive, very IP-rich company, and they were able to take some of that cash from the captive and through taking a security interest in the portfolio, transferring some of that cash to the parent to replace some higher interest debt. So basically, it was a win-win in being able to securitize, but it really recognized the value of that portfolio. So we were able to value the portfolio at a certain amount to be able to justify the movement or the securitization of that portfolio. But that's another example of the power of the value of IP.
Yeah, so the key here is if you are an innovative company that is looking for strategic ways to leverage assets that aren't being leveraged today, we now have the capabilities to assess and value IP at speed and at scale to allow organization to leverage those assets for the first time. It's really quite special.
Yeah. And we've got just a moment on the innovation that we're protecting. So I think you've got, through the recession and the recovery, you've got different areas of ways to contain or ways to address innovation in a different way. So we're looking at trade secrets being an innovative way for companies to think about an alternative to patenting. And so companies are keeping trade secrets, and a good example is a Coca-Cola trade secret for their syrup, or the Google search algorithm. So those are good examples. So being able to innovate at the same time, being able to capture them in a way that over on the left, we've got a trade secret registry where you're able to take those and categorize those and register those, in this case using blockchain, to be able to protect those innovations. And also we have ways to help companies think through and analyzing how to identify what those assets are, and then being able to manage and protect those in the proper manner. So we do that through a corporate risk profile, where we're actually able to help companies think through what is the right way to protect these things. How can I think through areas like policy and governance and procedures around the area of trade secret management. So we've gone through, thank you for your attention today. We've gone through a lot of information, and hopefully in this very difficult time, we've given you a broader appreciation for the value of intellectual property and showed how it can create opportunity as well as risk. And we've shown ways to mitigate that risk as well as increasing enterprise value by focusing on intellectual property as an asset. Thank you very much.